When an owner-operator applies for commercial truck financing, they usually expect a fast yes or no. Instead, the process drags on. The reason it takes 2 agonizing weeks instead of 2 days rarely has to do with your credit score. It comes down to disorganized paperwork. A standard, poorly prepped application cycle looks like this. You apply on Monday. Underwriters ask for statements on Tuesday. You scramble to find by Wednesday. By Thursday, the P&L is missing, and your file is pushed into next week's queue. Contrast that with a prepared carrier. By submitting a complete, flawless package on day one, they secure funding in exactly 48 hours, using the exact same credit profile, revenue history, and target truck. Every day your truck isn't hauling freight, you are burning capital. This bar chart breaks down the average commercial operating cost, which currently sits around $2.01 per mile. Against those fixed expenses, most carriers survive on a net margin of just 3 to 8%. You cannot afford weeks of downtime. Assembling a complete funding package up front is the single most effective action you can take to protect those margins and get your asset generating revenue. Step 1 is proving your identity. Lenders universally require a valid government-issued ID for all business owners. It is a simple requirement, but forgetting to attach a clear, color copy of your driver's license frequently halts applications on day one. Next are your business bank statements, and the requirements scale with the size of your loan. For requests under $75,000, you might only need 3 months of statements, but if you are financing a new rig over $150,000, expect to provide a full year. This split-screen graphic compares deposit health. Underwriters scan your statements for specific deposit patterns rather than the ending balance. On the left, a clean statement displays consistent, predictable freight income from brokers or shippers. On the right, the red flag statement shows the opposite. Underwriters are actively scanning for application killers. The most common are non-sufficient funds, or NSF fees, frequent overdrafts, and desperate transfers from your personal accounts to cover business expenses. Then comes your profit and loss, or P&L statement. This document proves that your gross revenue adequately covers your heavy operational expenses, like fuel, commercial insurance, and maintenance, before a new truck payment is even considered. Clean bank statements and an up-to-date P&L verify your income and prove you possess the strict financial discipline required to survive industry volatility. Tax returns follow a similar tiered structure. For financing under $75,000, they are often waived. But crossing the $150,000 threshold or applying for an SBA loan automatically triggers the need for comprehensive personal and business tax returns. You will also need a current balance sheet. This assures the lender that your company's owned assets safely outweigh its existing liabilities. This balance feeds into your debt service coverage ratio, or DSCR. This equation compares your available cash flow against your monthly debt. To approve a new commercial truck loan, underwriters demand a ratio of 1.25 or higher. Your business debt schedule lists everything you owe. If you hide a merchant cash advance, those high-interest daily debits instantly destroy your DSCR calculation the moment they're discovered. Hiding existing daily debit obligations guarantees an instant denial during the underwriting phase. The math will always expose hidden debt. Providing full transparency on your debt schedule from day one is the fastest way to build underwriter trust, ensuring your DSCR is calculated accurately before you sign a purchase agreement. Once your personal and business finances are verified, we move on to the collateral, the actual physical asset you are trying to finance. Lenders will check your MC number to verify your authority age. If your authority is less than a year old, you are considered a startup, and you will face vastly different lending criteria, including higher down payment requirements. Because of this risk, generic pre-approvals do not work in commercial trucking. The lender needs the exact dealer invoice or a detailed spec sheet showing the year, make, model, and VIN. Traditional lenders demand used Class 8 trucks be under 10 years old with fewer than 700,000 miles. The logic is pure math. Older trucks break down. When a truck is in the shop, freight revenue halts, which subsequently stops your ability to make loan payments. Providing precise specifications and proving your established authority shows the lender your target truck is a safe, reliable asset capable of generating continuous revenue. Now we reach the final step, assembly. You take all 8 required documents, your ID, bank statements, P&L, tax returns, balance sheet, debt schedule, MC registration, and dealer invoice, and compile them into a single digitally compressed folder with clear file names. When you attach this comprehensive folder to your initial application, you give the underwriter everything they need to run their models immediately. You completely eliminate the multi-day back-and-forth communication loop of missing files and stalled emails that plagues disorganized operators. This level of organization is what separates the drivers stuck waiting on paperwork from the owners driving out of the dealership. A ready-to-send digital funding package ensures quick approval, putting the truck on the road and revenue in your pocket in just 48 hours.